Hi. Let's learn about the Investment Company Act of 1940. The Investment Company Act of 1940 is an act of Congress that sets standards for the investment company industry and is designed to protect investors. It ensures that investors are aware of the risks associated with securities and requires investment companies to provide information about their investment objectives, investment policies, and financial condition. The Act is regulated by the Securities and Exchange Commission and targets publicly traded retail investment products. The legislation was passed to create a more stable financial market regulatory framework following the stock market crash of 1929. It details rules and regulations for U.S. investment companies, addressing requirements for filings, service charges, financial disclosures, and more. The Act defines what qualifies as an investment company and outlines registration requirements for companies offering securities in the public market. Companies register for different classifications based on their product offerings, such as mutual funds/open-end management investment companies, unit investment trusts, and closed-end funds/closed-end management investment companies. The Dodd-Frank Act, signed in 2010, created new government agencies to oversee different aspects of the financial system and impacted the registration and disclosure requirements for hedge funds and private equity funds under the Investment Company Act of 1940. The Act was established after the 1929 stock market crash and the Great Depression to protect investors and bring more stability to the financial markets in the U.S. The Act defines an investment company as an issuer that is engaged in the business of investing, reinvesting, owning, holding, or trading in securities, and owns or acquires investment securities exceeding 40% of its total assets. Companies can qualify for exemptions based on their structure, activities, and size, including those that provide advice on the economy but not securities, certain subsidiaries, and companies with fewer than 100 investors. The Act tightened financial regulation, giving the SEC more power to oversee financial markets and creating rules to protect investors and require investment companies to disclose information. The Investment Company Act of 1940 was passed to provide the SEC with the power to oversee investment companies and protect investors. Its purpose remains the same over the decades, despite changes in financial markets. Here are 5 key takeaways. 1. The Investment Company Act of 1940 is an act of Congress that regulates the formation of investment companies and their activities. 2. The legislation in the Investment Company Act of 1940 is enforced and regulated by the Securities and Exchange Commission, SEC. 3. Companies seeking to avoid the product obligations and requirements of the Act may be eligible for an exemption. 4. The Act was signed into law by FDR, who wanted to protect investors after the stock market crash of 1929 and the Great Depression that followed. 5. The Act has gone through many changes over the decades as financial markets have evolved and become more complex. Hope this would help. Thanks for watching.